Good day everyone, thank you for joining me. I am Tamara Kukshinovich and I'm going to take you through the real estate sector event impact assessment. The South African real estate sector was significantly hard hit by the pandemic. COVID-19 has accelerated the long overdue impairments and the disintegration of the relationship between property fundamentals and the premium that was placed on the counters. As a result, the sector price to net asset value is trading at an approximate 50% discount. The market has placed higher discounts specifically on counters with weak balance sheets. However, some companies have held up during the crisis, particularly Equites, Sirius and Stor-Age. So we have done some further analysis to identify any potential value. As you can see in the graph on the right, year to date, Equites, Sirius and Stor-Age have outperformed the SAPI. Sirius has notably outperformed the SAPI with a positive return, which is likely due to it being exposed solely to Germany, its exposure to storage, its focus on smart spaces, as well as the rand weakness. On a price to book basis, Equites, Sirius and Stor-Age are trading at a premium relative to peers. The market has placed more value on the shares given the strength of their balance sheets. When comparing their price to book values with the historical averages, Equites and Stor-Age are trading at a discount. On the other hand, Sirius is trading at a premium relative to its historical average. Looking at current price to net asset value, Sirius and Stor-Age are trading at a premium, while Equites is trading at a slight discount. Equites has stronger property fundamentals with the longest weighted average lease expiry of 10 years and a high occupancy of over 96%. It also has the best tenant quality mix, with 95% of tenants being A or P grade tenants. On top of that, Equites management has provided guidance that it will continue to pay out 100% of distributable earnings. Geographically, Equites has exposure to the South African and the UK market. We also like the segmental exposure of the counter. As you can see in the first graph, it is diversified and 95% of it lies in the logistics area. There is a small exposure to industrial and commercial, and there is no exposure to retail. Because of this, the pandemic had a minimal negative impact on the group. The balance sheet is sound. There is adequate headroom, with the loan-to-value ratio sitting at 29.5%, and the interest cover ratio sits comfortably at 2.8 times. Equites has a comfortably staggered debt maturity profile, with less than 15% of debt facilities as a percentage of market cap expiring in the next 2 years. In an environment where asset prices are falling and a rights issue may be required to de-risk the balance sheets in the property sector, we feel that these counters are in a favorable position. We believe that it is unlikely that they will be forced into a rights issue to de-risk their balance sheets. On an absolute basis, we feel these counters have value, but they do not seem cheap relative to the rest of the property universe. The strength of these counters' balance sheets is fully reflected in their current share prices, as they are trading at premiums to the sector. This is why we remain neutral on all three counters for portfolios with a property-only mandate. When comparing the three counters, we believe that Equites has the largest valuation upside, and we anticipate recovery to be closely linked to the South African and UK macroeconomic outlook. To conclude, Equites is our preferred property exposure. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. A comprehensive EIA report on these counters can be found on the PSG online trading platform. And before we end off, please take note of the following disclaimer. Thank you.